BigBear.ai, ticker BBAI, is trading live right now at $7.15, posting a very strong intraday gain of 5.68%. Volume is absolutely surging, with over 128 million shares already changing hands, smashing its daily average and signaling a massive wave of new interest in the name. And while most traders are seeing this pop and just lumping it in with the general artificial intelligence sector momentum, they are missing the specific, tangible news that is actually driving today's move. The real story, announced just this morning, is that BigBear.ai has completed a major deployment of its Veriscan biometric identity platform at Chicago O'Hare International Airport to support U.S. Customs and Border Protection. This isn't just another vague AI press release. It's a hard asset deployment in one of the world's busiest airports, a critical step forward for a company desperately trying to prove its commercial viability. The common belief around BBAI has always been a simple one. Investors see the .ai in the name, they hear about its deep ties to the U.S. military and intelligence community, and they frame it as a potential mini Palantir. The expectation is that this is a small-cap stock sitting on a mountain of government contracts, just waiting for the AI hype train to recognize its value and send the price flying. People buy this stock expecting it to duplicate the success of its larger-cap peers, believing they're getting in on the ground floor of the next big defense tech story. This narrative is powerful, and it's why the stock has seen such explosive boom and bust cycles over the last couple of years. But the reality, as is so often the case, is far more complicated and far more challenging. The truth is that BBAI is not just a high-growth AI story, it's a company with two very different personalities locked in a struggle for profitability. On one side, you have the legacy government contracting business. This side is characterized by large, impressive-sounding contract ceiling announcements like the $165 million U.S. Army Global Force Information Management contract. This sounds fantastic, but the reality of government work is that it's often slow, lumpy, and, as the company's own financials have shown, not always profitable. The company's first quarter 2025 results back in May highlighted this tension. While they affirmed their 2025 revenue outlook of $160 million to $180 million, they also posted a GAAP net loss of $62 million for the quarter, and perhaps more importantly, a negative adjusted EBITDA of $7 million. This signals significant cash burn, the very thing that the market punishes most severely in a high interest rate environment. This brings us to today's news about the O'Hare deployment. This is the other side of the company, the scalable, commercial-facing biometrics and digital identity business. This is the part of the company that investors should be focused on, as it represents the potential for high-margin, repeatable revenue that can break it free from its reliance on slow-moving government projects. This O'Hare deal is a massive proof of concept. It takes their technology out of the abstract defense world and places it firmly in the commercial sphere, vetting travelers in a real-world high-throughput environment. The market is reacting so strongly today because this news directly attacks the primary bear thesis that BBAI is just a low-margin government services company masquerading as a high-tech AI play. This deployment suggests they might actually have a scalable, competitive commercial product. This tension is visible everywhere in the stock's recent performance. On a yearly basis, BBAI has been a monster performer, outperforming roughly 98% of the market. It has a 52-week low of just $1.51 and a high of $10.36. But more recently, the stock has been in a painful pullback, trading in a wide range between roughly $6.30 and $9.40. Before today's pop, it was languishing near the lows of that recent range as investors grew impatient with the cash burn and the lack of new catalysts. Today's 5.7% surge on 128 million shares of volume is a technical bounce off that lower support level, fueled by a fundamental catalyst. The question now is whether this is the start of a new leg up or just a one-day wonder that will get sold off by traders taking profits. Now, we absolutely must talk about the short-selling situation in this stock because it is one of the most misunderstood aspects of BBAI. Given its volatility and its popularity on social media forums like Reddit, many investors just assume it's a classic, heavily shorted meme stock ripe for a squeeze. The expectation is that a large, coordinated short position is suppressing the price. But the reality of the data tells a very different and much more nuanced story. Let's look at the numbers, which you can find on data platforms like Fintel or S3 Partners. The short interest as a percentage of the free float is indeed high, standing at approximately 18.4%. This means nearly 1 out of every publicly available share is being used to bet against the company. This confirms that there is a significant bearish contingent of traders. But this is where most retail analysis stops. They see the high short interest and they assume a squeeze is imminent. They are missing the other and more important variables. The first is the days to cover, which currently sits at just 0.64. This metric tells you how many days of average trading volume it would take for every short seller to buy back their shares and close their position. A number this low, less than 1 full trading day, means the shorts are not trapped. They can get out of their trades easily and quickly if the price moves against them. A high days to cover, say 5 or 10 days, is what creates the panic in a short squeeze. BBAI does not have that. The second and the most telling piece of data is the short borrow fee rate. This is the annualized interest rate shorts must pay to borrow the stock. For many high-demand squeeze plays, this rate can skyrocket to 50%, 100%, or even 500%. For BBAI, the borrow fee rate is currently a tiny 0.69%. This is practically free. This low rate tells us that even though 18% of the float is shorted, there is a massive supply of shares available to be loaned out by brokers. There is no scramble, no panic to find shares to short. This combination, high short interest but low days to cover and a rock bottom borrow rate, suggests that this is not a crowded, panicked meme short. Rather, it's a large, stable, and fundamentally driven bearish position. These shorts aren't betting on a technical squeeze, they are betting that the company's fundamentals, specifically its cash burn and profitability struggles, will eventually force the stock price lower. They are not trapped, and a squeeze is therefore highly unlikely. What's your take on that low 0.64 days to cover? Does that change your perspective on a potential squeeze, or do you think the 18% short interest is the more important number? We can also see some interesting, though not alarming, signals in the fail to deliver or FTD data, which is reported by the SEC. FTDs are settlement failures, a share that was sold but not delivered to the buyer on time. In late September, BBAI saw some significant spikes in FTDs, including one day with over 1.8 million shares failing to deliver. While this can be caused by many benign factors, persistent FTDs can sometimes correlate with high short volume and settlement stress. It's not a smoking gun, but it's another dashboard item for serious investors to monitor, especially as it shows the plumbing of the stock can get stressed during periods of high volatility. This complex reality is reflected perfectly in the retail investor sentiment you see online. On one side, you have the long-term bulls on Reddit and Twitter, who are convinced this is a 10-year hold. They compare it to Palantir, arguing that BBAI is the one that actually analyzes the data, while Palantir just organizes it. They see the $165 million Army contract and today's O'Hare nows as proof that the thesis is working. On the other side, you have deeply skeptical investors who point to the financials, the $62 million quarterly loss, the negative EBITDA, and the years of sluggish revenue growth as proof that this is, in their words, an AI pretender meme stock that is burning through cash with no clear path to profitability. This debate is the stock. So, who owns the company? The institutional ownership data is fascinating. As of the latest filings, 406 institutions have positions in BBAI. The largest holders are who you'd expect, the massive index funds. Vanguard is the top holder with nearly 21 million shares, and BlackRock is right behind them with over 20 million shares. This shows that BBAI is part of the broad market indexes, providing a stable base of ownership. But further down the list, you see the smart money. Citadel Advisors, a massive quant hedge fund, holds over 6.4 million shares. Renaissance Technologies, another legendary quant fund, holds 5.5 million shares. The presence of these top-tier funds means the stock is being very, very closely watched. They are in it for the volatility and the algorithmic trading opportunities, which contributes to the wild intraday swings we see. Looking forward, the entire story for BigBear.ai hinges on its ability to prove the skeptics wrong. The expectation, fueled by today's O'Hare news, is that the commercial biometrics business can finally become the high-growth, high-margin engine the company needs. The reality is that it is still a small part of the overall business, and the legacy government contracting business is still a heavy drag on profitability. The next major catalyst will be the third quarter earnings report, which is scheduled for November 10th. This will be the moment of truth. Investors will ignore the headline revenue number and look for two things. First, any improvement in cash burn and adjusted EBITDA. They need to see a path to self-sufficiency. Second, they will want to hear any color on the commercial pipeline. Is the O'Hare deal a one-off, or is it the first of many? The analyst ratings reflected this deep uncertainty. Price targets are all over the map, with a low-end target of $1.52, which would be a total collapse from here, and a high-end target of $8.40. The consensus is a buy, but with an average target that implies very little upside from the current price. This shows that Wall Street is just as divided as retail. They see the potential, but they are terrified of the cash burn. Before we finish, I want to hear from you. Are you more interested in BBAI for its core government contracts or its new commercial biometrics platform? Comment GOV or COM below. In the end, as BigBear.ai trades near $7.15, today's 5.7% rally is a microcosm of the entire stock. The expectation is that this is the AI play finally getting its due. The reality is that this is a company at a critical crossroads, making a very real and tangible push into the commercial space to try and outrun its own balance sheet. The O'Hare contract is a genuine positive development, but the fundamental challenge of turning potential into